Hey guys, welcome back to another episode. In this video we will be going through our high probability CCI moving average crossover trading strategy in depth and how we use it in combination with price action. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto, because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. CCI moving average crossover trading strategy. The logic for CCI moving average crossover trading strategy is simple because we are combining both a trend following indicator as well as an oversold overbought indicator. Moving averages can show you the approximate trend and change of trend when the crossover occurs. CCI is an oscillator that shows you whether the market is oversold or overbought. CCI moving average crossover is one of the most effective price action strategies you can use in the market. This system allowing traders to determine if they want to enter or exit a trade, refrain from taking a trade, or add to an existing position. Moving average crossover. Because moving averages are a lagging indicator, the crossover technique may not capture exact tops and bottoms, but it can help you identify the bulk of a trend. A moving average crossover system helps to answer these three questions. First, which direction might the price be trending? Second, where might be a potential entry point for a trend trade? Third, when might a trend be ending or reversing? All you have to do is plop on a couple of moving averages on your chart and wait for a crossover. If the moving averages cross over one another, it could signal that the trend is about to change soon, thereby giving you the chance to get a better entry. By having a better entry, you have the chance to bag more pips. Let's take another look at this 1-hour chart of Euro-United States dollar to help explain moving average crossover trading. From around 4 days, the pair was in a nice uptrend. It topped out at around 1.2 before slowly heading down. In the 1st of September, we see that the 10 EMA crossed below the 30 EMA. And what happened next? A nice downtrend. If you had shorted at the crossover of the moving averages, you would have made yourself more of 1,000 pips. Of course, not every trade will be a 1,000 pip winner, a 100 pip winner, or even a 10 pip winner. One thing to take note of with a crossover system is that, while they work beautifully in a volatile and trending environment, they don't work so well when price is ranging. You will get hit with tons of crossover signals, and you could find yourself getting stopped out multiple times before you catch a trend again. In summary, moving average crossovers are helpful in identifying when a trend might be emerging or when a trend might be ending. The crossover system offers specific triggers for potential entry and exit points. These triggers should be confirmed by chart pattern and indicator. Indicators assist traders in confirming high probability trades. Depending on the trading plan and strategy, traders will have one or two indicators that complement the trading strategy. Do not fall into the trap of overcomplicating the analysis by adding multiple indicators to a single chart. Keep the analysis clean and simple and easy to view at a glance. Using the CCI as a trend indicator. The Commodity Channel Index or CCI indicator is a momentum-based oscillator used to help determine when an investment vehicle is reaching a condition of being overbought or oversold. Developed by Donald Lambert, this technical indicator assesses price trend direction and strength, allowing traders to determine if they want to enter or exit a trade, refrain from taking a trade, or add to an existing position. In this way, the indicator can be used to provide trade signals when it acts in a certain way. The CCI trend indicator can be used to signal the strength of the trend. When a trend exhibits strong momentum, there is a high probability that price will continue rising or falling. This means you can expect price to continue in the same direction. So, the next time you want to know how strong the trend of a security is, simply look at what the CCI indicator is suggesting. Using the CCI as a trend indicator is ideal when combined with other trend indicators such as moving averages. This can help you to pick bottoms in a rally or tops in a decline. In other words, using the CCI as a trend indicator, you can time your entries within a trend. How can you use the CCI trend indicator? In this example, you have the 30 and 10 period exponential moving average or EMA applied to the price chart. When the short-term exponential moving average is above the long-term exponential moving average, it signals an uptrend. Now, using the CCI indicator, you can see that the bullish momentum is renewed every time the CCI falls below the -100 level. When the CCI indicator starts to rise back above -100, the bullish trend resumes, thus giving traders a good level to enter the trend. Using the CCI as a trend indicator can help you to time your entries into a trend. Instead of buying at the top or selling at the bottom, which usually happens with most traders, the CCI index can signal to you when the best time is to enter a trend. CCI moving average crossover trading strategy details. You can use any time frame, but consider that amount of noise on lower time frames. Consider using 15-minute charts and above. As mentioned in the title of this video, we are going to use only two trading indicators. First, two exponential moving averages set at 30 and 10. We use a fast and slow exponential moving average so we can see the potential trend change earlier. Second, CCI or Commodity Channel Index with the setting of 7, which is much lower than the standard setting of 14. Note: do not add any other technical indicators to the mix for this strategy. The only addition will be the use of candlestick patterns of individual candlesticks. Trading strategy rules. Please ensure you fully test the rules so you can do them without thinking. Selling rules or short position. First, 10 EMA crosses the 30 EMA to the downside. Second, wait for price to rally back to the moving averages. Third, the CCI above the 100 level and start crossed below it. If those 3 points line up, you have a sell setup happening, and to confirm the trading signal, you may want to use a price action entry such as a bearish reversal pattern. Once you enter the trade, you can set an initial stop loss above the recent high. Buying rules or long position. First, 10 EMA crosses the 30 EMA to the upside. Second, wait for price to retrace back to the moving averages. Third, the CCI below the -100 level and start to rise back above it. Here are other examples of CCI moving average crossover trading strategy. CCI moving average crossover is one of the most effective price action strategies you can use in the market. This system allowing traders to determine if they want to enter or exit a trade, refrain from taking a trade, or add to an existing position. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and leave us a like to show your support. See you next time.